And now it's time for Talking Trade with Sandy Siegel and Ken Wasley, sponsored by the Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategies.
Hi, everybody. I'm Jeff Mayers from WisPolitics.com and WisBusiness.com, here with another edition of Talking Trade. I'm filling in for Ken and Sandy, who are off this week. I want to thank our sponsors, first of all, the Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategies. Now I want to welcome in our guest, Rohini Potluri. She's a vice president at USBank, specializing in foreign exchange and derivatives, and she focuses on advising business banking customers across the Midwest, helping them manage global payment risks and protect margins through tailored strategies. Welcome, Rohini.
Sure. So firstly, to begin with a quick intro, I am a vice president in foreign exchange at US Bank, and I work with businesses that buy from suppliers overseas and sell products and services internationally, right? So my role is to help these companies understand and manage the impact of currency fluctuations on their businesses. So, to give you an example, if a company agrees today to pay a supplier in Europe 6 months from now, the exchange rate may be very different when that payment comes due. And my job is to help businesses navigate that uncertainty and create more predictability around their costs, cash flow, and profitability. And beyond managing risk, I also help companies think strategically about pricing, competitiveness, and international growth in general.
Okay, so it's been a heck of a year. If we go back to uh, mid 25 to now, what's been driving the volatility?
So, before I speak about markets in general, I wanted to speak about how currency fluctuations, first of all, affect the trade, right? Is it okay, Jeff?
Sure.
Because I really wanted to focus on how companies are seeing that impact. So, currency fluctuations can have a direct impact on companies' bottom line, right? So, imagine a Wisconsin manufacturer agrees to purchase 1 million euros worth of equipment from Europe. And if the euro strengthens before payment is due, that same purchase could cost tens of thousands of dollars more, right? Just like what we saw last year with the euro appreciation of close to 18%, and with tariffs, many US importers saw a significant increase in costs because of these two factors, right? Now on export side, if a US company is selling products overseas and receiving foreign currency, exchange rates are changing every second, and that can affect how much revenue they ultimately bring back home. And one misconception, Jeff, I hear frequently is we invoice everything in US dollars, so we don't have currency risk. However, in reality, companies are often just shifting that risk to their customer or suppliers rather than completely eliminating it. And it's because someone in the transaction is absorbing that currency risk, right? And in some cases, requiring a foreign customer to pay in dollars can make a company less competitive versus a competitor willing to offer pricing in customers' local currency. So to
So, I mean,
bring
what do you advise let's say, an American manufacturer? What do you advise them? Do you advise them to do it all in dollars or to do it in local currency, or how do you assess how they should do it?
So let's split it between exporters versus importers. So for exporters, billing customers in local currency at the same time simultaneously hedging the exposure can create a win-win situation for both parties, right? The overseas customer gains pricing certainty in their own currency, while the US exporter gains certainty around how many dollars they will ultimately receive. So now the exporter is not exposed to the market or the overseas customer. However, if you look at importers, there can be substantial cost savings coming from um, uh, foreign currency in general, right? So paying suppliers in foreign currency, and just like exporters, hedging can help them understand the true cost of product and budget future dollar expenses more accurately. So, for example, I closely work with a manufacturer based out of Iowa who purchases all of their product from German customer or German supplier, and they have, let's say, close to 6 million euros worth of obligations in a year, right? So the market is moving every single day. Just like I mentioned, the euro has appreciated by close to 20% last year. So, how can the company better budget the dollar cost given the market is moving every single day? That is through hedging, is where they can lock in their US dollar prices, set their profit margins, and set their customer pricing accordingly.
Okay, so what's been driving the volatility? You mentioned tariffs. What else is driving the volatility?
So there is, I mean, the current main headlines are obviously tariffs and Iran conflict, right? So, but however, um, geopolitical events in general certainly creates headlines and short-term volatility. Like tariffs can influence trade flows, business sentiment, and inflation expectations. At the same time, conflicts in Middle East can impact energy prices and investor confidence, right? However, over longer periods, currencies tend to be driven primarily by interest rates, inflation, and economic growth expectations. So, markets spend a lot of time evaluating what central banks may do next when expectations around interest rates change. And currencies often quickly react based on the macro headlines in terms of central bank actions, right? So while tariffs and geopolitical events matter, central bank policy and economic fundamentals are often the larger drivers for longer term currency trends.
So you mentioned interest rates, and that's been a focus, and we have a new Federal Reserve chairman who can't, by edict, lower rates, but has talked about changing the focus of the inflation index. So I'm
Mhm.
wondering, how does this affect the value of the dollar, do you think? Is the dollar still king in terms of currencies?
So, in my view, yes, the US dollar remains the world's primary reserve currency and continues to play a dominant role in global trade and international payments. While there is growing discussion around diversification and alternative payment systems, the dollar benefits from the size of the US economy, deep capital markets, and global liquidity. And for businesses engaged in international trade, the dollar remains the benchmark currency for much of the world. And I don't see that changing anytime soon.
Okay, so let's go back to the approach that, again, somebody here in the US, an exporter, or somebody in the US here importing, how would you advise them? What's your outlook for the rest of the year? What kind of strategies would you advise them to think about going forward?
So I would say, rather than trying to predict exactly where currencies are going, I think the bigger opportunity is preparedness, right? So currency markets can move quickly when trade policy, inflation data, economic growth, or central bank expectations shift. And companies that understand their exposures and have a disciplined approach to managing risk are often in a stronger position regardless of the market direction, right? So my recommendation is that businesses take a consultative approach by speaking with their foreign exchange partners or international banking teams or trade experts to discuss solutions that fit their business. And every company has different exposures, and often um, a short conversation can uncover opportunities to improve certainty, budgeting, cash flow forecasting, or competitiveness in international markets. It's because the goal isn't necessarily to beat the market. The goal is to reduce surprises and create greater certainty around financial outcomes.
Well, in an uncertain world, if you can bring certainty, I think that's going to be a great thing for your customers. So we've come to the end of the podcast today. Rohina, I want to thank you very much for participating. You've shed a lot of light on, I think, a obtuse topic for many of us, but I think you've helped a lot. So, audience, thank you very much for watching another edition of Talking Trade, and we'll see you next time.
You've been listening to Talking Trade with Sandy Siegel and Ken Waslick, sponsored by the Dairy Farmers of Wisconsin, Carroll University, and Michael Best Strategy.